It's time for a new update on interesting growth stocks. Indeed, 3 for this video, selected for you after countless hours of research. 3 new growth stocks that we haven't discussed before, but which may have very impressive long-term growth potential. There is always risk when investing in growth stocks. What I myself have been doing for more than 10 years is paying a higher valuation in the short term because you might expect them to be worth much more in the future. So normal metrics like price to earnings are therefore somewhat less certain, and that results in much more price fluctuations in the short term. After all, quarterly results often lead to panic or, conversely, to euphoria. And we will see that these 3 stocks have all individually dropped recently by about 50%, 30%, to even 45%. But all 3 potentially have impressive growth potential, especially the first stock that we are going to look at shortly. And it has many characteristics of another stock with which I achieved more than tenfold returns in 1 year. Not one-to-one comparable, but it has a number of interesting characteristics that could potentially lead to exponentially moving returns in the long term. But you also know the market is often quite efficient. With these stocks, I don't think so, but if everyone already knows, then often the value or the price is, of course, already factored in. So we need to have exceptional knowledge and foresight or a higher willingness to take risks from uncertainty. To be successful in this also means that the uncertainty is less, clear for the future, and thus it can sometimes turn out to be quite disappointing. That's why I always invest smaller amounts in growth stocks with higher risk. Think of percentages like 1 or 2% in an explosively growing stock as already being quite a lot. If it makes 10 times this time, you'll be very happy. If it drops 100%, yes, then you've lost 1 or 2%, and that's not the end of the world, so it's less shocking. My name is Jorik Vermeulen, owner and founder of Happy Investors. Check out our website. There you'll find all sorts of free downloads, such as the stock book and also a book about investing in ETFs, including a starter kit, a calculation tool, and more free resources. You can also gain access to our community for free or subscribe to our newsletter. Also free with many current updates on how to achieve financial freedom, passive investing, and long-term investing. Let's take a look at these 3 interesting growth stocks. Outside of our company, Happy Investors, we conduct a lot of stock analyses, and I personally analyze stocks daily. I use multiple tools for that. It's no secret. We see here Motley Fools, but we also have Foles, Crafts. We have Seeking Alpha. We have Market Screener. And we have, for example, TradingView. We simply have paid programs for that, often the more expensive versions. In total, we spend more than 10,000 euros per year on these companies. And software, I should actually say. And yes, we made a lot of analyses available for free via YouTube, our way to share value with you. Also for inspiration, it is never investment advice. Pay close attention to that, all purely for inspiration. If you are interested in any of these programs, often we have a discount link. You can find it in the description of our YouTube videos. We also receive a commission for that, but you never pay more. At the very least, you get a discount, but you will never pay more, and we get a share of the revenue. But what we don't have an affiliate link for, no partner link, is Motley Fools. However, I'm always someone who believes you should just wish others well. And I'm not super enthusiastic about Motley Fools, but every now and then they have interesting insights. For example, this company, Candle Holdings, well, thanks to Motley Fool, I came across it. I didn't know it at all at first, and I need more time for thorough research into what exactly the company does. But a first impression is very positive, and that's why I want to share it with you for inspiration. Partly because the stock price has recently dropped by 30%, and a dip of 30% doesn't happen that often. So yes, it might be that I need months of research to reach a conclusion, but then I might be too late because the stock has already, risen. The teasers from Motley Fools are quite interesting. As a result, I started doing more research. And in a nutshell, there are a few things that stand out to me, and we will also look at the characteristics of the stock. It is a spin-off from IBM. Spin-offs are always very interesting because they are often not well assessed. There is a growing demand for their software and services in IT infrastructure. And what is particularly interesting, for example, is that the stock is on the verge of an inflection point. I'm just looking for it. What's written here? Oh, yes. Why now? Candle is at profit-making inflection point. Another stock I've had a lot of success with is a Plovin. It first dropped a lot and then rose tremendously because they were at an inflection point of profit-making, so from loss to profit. Another example in my portfolio, Hims and Hers. I was one of the first to buy it in 2021. After the IPO, it was a bit too early. I actually kept buying more at lower valuations and achieved enormous returns, thanks to Hims and Hers. And I was much earlier than the rest in the market because you understand the company. Well, I don't understand Candle Holdings that well yet. Only the pattern is actually the same. First, it dropped a lot, even about 80% since the spin-off. And yes, but that is relative to a deep low. Let's take a slightly higher price level. Since then, it has risen by about 200%. So that's your investment times 3. And now it has dropped by about 30% relative to the, yes, all the noise around levies and such. A 30% drop is quite interesting, but the valuation is not yet to say super cheap. At least that's how it seems. I just need more research and time for that. In a nutshell, the company tries to provide mission-critical software for IT systems, mainly information systems, and they are active in several IT trends. The biggest one is cloud. What you see here, percent of revenues, so percent of turnover. Core enterprises, those are 2 big ones. A bit of network, and very small, for example, are beta, apps, and AI. That often occurs in the programs. In the latest Q3 earnings updates, they indicate, and this is very interesting, that the adjusted free cash flow can increase to about 1 billion in the fiscal year of 2028. The current market value is approximately 6.5 billion. That means you are paying a free cash flow of 6, and that is very little, especially if there is long-term growth potential. But I'm not super enthusiastic yet. Everywhere you see the word adjusted, pre-tax income, adjusted margin. If you follow Charlie Munger, then you know adjusted stands for bullshit earnings. Well, I don't mind speaking in terms of EBITDA, adjusted, and those kinds of things, but everywhere you see the word adjusted. I don't completely trust that, so I want to conduct thorough further research on it. The CEO is also not what I think, well, a true visionary, but, well, who am I to judge that? He comes from IBM, and as far as I can see, quickly on his LinkedIn and such, he hasn't really had a CEO position yet, so that's positive, I think. This is the first time he is in a CEO position. Still a bit of a drive to prove himself that you might still have. And he has also done, for example, IBM Global Financing, which is, of course, very interesting. A man who knows finance, but, well, he's not an Elon Musk, for example. So there are pros and cons, but you should never focus entirely 100% on management. However, if you are making a real long-term investment, then management is indeed one of the more critical success factors for the long term. A number of characteristics we are going to look at. Morningstar gives a fair value estimate of $38, while the current price is $30. No economic moat at the moment. And of course, you have to calculate everything based on the fundamental development of companies. So will they make much more profit in the future? That is crucial. But analysts must think so. Their price targets are much higher compared to the current price, with an average upside potential of 45%. And the lowest estimate is a price target of 38. That is still plus 30%. So the question is, of course, why are all these analysts so enthusiastic about this company? If you look at, for example, fast caps, that usually doesn't work well for growth stocks. But it is remarkable that Kindle seems to have enormous growth potential based on EPS development. There aren't many analysts who have provided an estimate here, but the estimates are very high. So an EPS by the end of 2026 that then rises to 2, and also here an earnings per share that rises to 3.4. So those are very large profit increases. Suppose that turns out to be the case. This scenario, while the current price earnings is still somewhat high, the price earnings for next year is estimated to be around 23. Yes, then you would want to pay a higher price for such a growth stock. That could be a price earnings of 30, but then you see higher returns. Let's be a bit more cautious ourselves and stick to a price earnings of 15. Could it be that you achieve an average return of 30% or a total return of 125% over the next 2.5 years? That is, of course, a very good return. Whether it will happen, yes, no idea, of course. That is forecasting. You always have to take it with a grain of salt. But the analysts' outlooks are very positive, so that's why it seemed to me to do a lot more research into this company. For example, the PEG ratio. It is estimated at 0.7 and the price earnings for next year is then estimated at 20, and for 2027, even only 10. That gives a free cash flow yield of 11%, quite high. There are, of course, some points of attention, as you can see, but the EBITDA growth, for example, means a strong increase. From seeking alpha, it receives a factor analysis, a strong buy, and thus 4.6. Especially because the momentum is very strong, and the revisions. In other words, analysts expect this company to make more earnings per share than initially expected. However, the price to sales is only 0.5, so that is very low. The book ratio is somewhat on the higher side. And the price to cash flow is also not particularly high. Quite a number of interesting characteristics. The market value is only 7 billion, not much at all. They do have a bit more debt, about 4 billion in debt. Pay attention to that. So look closely at the ratio of that debt. The maturity date, long term, yes or no. In the short term, they have 1.5 billion eyes in cash. What seems to be good? Of course, you should always carefully review what the presentations are in terms of figures. And then you also see here, for example, the net debt of 1.7 billion cash flow from operations. They have bought back a small amount of shares, so you naturally want to review all these kinds of figures yourself. Looking at the good figures from Seeking Alpha, not much in their database, so we'll skip that for now. Looking at a piece of profitability, we see that they indeed go from a loss to a profit. The 5-year average net profit margin was a loss and is now a small profit margin. And yes, well, if they can achieve, for example, a 5% profit margin here, or maybe even 10%, that would be nice, or perhaps even much more. Then the stock will rise very quickly, at least in the short term, even if only because of speculators who expect it to rise further. And of course, short-term momentum traders, return on equity and such. All of that is now improving rapidly, so those are quite positive developments. That's why I like to share it with you. Do you think it's interesting, whether it's a good investment for the very long term? I cannot tell you that yet. To be honest, the only thing I see in the short term is a 30% drop, and the prospects seem very interesting. The sector they are in is relevant. The sector is cloud, so also cybersecurity, those kinds of things. Information systems, that is, of course, a booming business. So it could be a very promising company for the long term, but more research is needed. I have put it on my watch list. Here you see a green symbol. Does it mean it's on my green list? A green list? I don't have many on it. They are only on the green list if I might invest in them. But if I were to do that, then I would. Due to the bit of uncertainty, I would only invest a smaller percentage, like 2%. If it then goes fivefold, that's great. If it doesn't go as expected, which sometimes happens with good stocks more often than not, yes, then the loss is, in terms of impact, at least a bit smaller. An interesting stock for the long term with impressive figures is Wingstop with the ticker WING. Now, the stock has recently dropped by almost 50%, but it is still anything but cheap. Let's take a look at why this stock might be interesting for the long term. Remember, the market value is currently only about 6.5 billion, so not very large, but the valuation is a bit on the high side. Now, Wingstop is basically just a fast food chain that sells in all sorts of forms and sizes. Now, I personally am a fan of chicken, although I eat vegetarian at home because my girlfriend is also vegetarian. But that's beside the point. They have quite a lot of locations, more than 2,500. It spans 11 global markets, but about 90% or so of the locations are in the United States. And they have really rapid expansion every year again. And not only that, for example, the system-wide sales growth is impressive, and they have achieved same-store sales growth for 21 consecutive years. That is quite impressive. It could be that at some point a tipping point will come, and then there will likely be a lot of short-term uncertainty, and the cash flow version is quite high, actually very high. Now, of all these chains here, the majority is owned by franchises. They only own 50 themselves, so more than 95% is in the hands of franchises, and that's why it's growing so fast. Recent quarterly figures are positive. If we look at the latest quarterly figures, for example, we see impressive growth are numbers. And this all looks great, even for the long term. So the history is important. They have also indicated that they are buying back a number of shares, and actually quite a lot. About 500 million in shares that they are buying back themselves. And I'm curious why that is. Quite a lot. That's almost 10% of the market value at the moment. And I'm very curious why, because the stock itself doesn't seem very cheap, at least in the short term. So maybe in the long term, so perhaps the management knows more. The CEO has a background mainly in finance and accounting. I don't really see any special matters further. Looking at Morningstar, they estimate a fair value of 180. That is lower than the current price. Therefore, it also gets 2 stars, and they do indicate that it has an economic moat. Now, Wingstop, yes, as I said, a fast food chain in chicken wings, and indeed 98% of the restaurants are owned by franchisees. So I took a look, just purely out of interest. If you want to become a franchisee, you must open at least 3 stores. Plus, you need a net worth of $1.2 million, of which $600,000 must be in liquid cash. So that's quite, yes, not everyone can open such franchises. Think a bit, for example, of a McDonald's, and that you also have to open 3 at once is, of course, advantageous for them. Yes, that's just how it goes. So maybe that's why they are growing very quickly. The average price target from analysts is actually somewhat higher in the short term. 300 means about a 40% increase compared to the current price. And Lowe's estimate is actually around the fair value estimate from Morningstar is quite interesting to investigate further. If we look at a bit of the historical development of this stock, we actually see that in the past, the price earnings have been particularly high for a very long time, and it only came around 50 once. That was here in 2022. In 2021, there was indeed a peak in terms of overvaluation of growth stocks. So all the good stocks have had significant corrections, more than 50%, and we see that with Wingstop as well. Well, the last peak was, of course, around this period, and the price was even above 100. I think it all looks extremely high, and I believe it actually is. And I wonder, even though the EPS growth is impressive and is estimated at quite high figures, as we can see below. Yes, if it disappoints, the price will naturally decline further. Only the business model looks interesting. I just personally have a bit of trouble with those high price earnings in the very short term. Then these are still good prices that we are paying now. And if it indeed maintains such a price earnings over the coming years, for example, 60, then you have an average return of 20%. But of course, there are countless scenarios to consider why this could go the other way. So I think if you find Wingstop interesting, you have to think from for the very, very long term, at least 10 years, but preferably even longer. And if you start looking at it from that perspective, then of course you get a different story. That market value is still relatively small and can naturally easily multiply over the very long term. The only question is, of course, in the short term, might there be better opportunities than the current ones? Now you're looking at a piece of valuation, which we also see with Market Screener. I don't see any special issues except that the free cash flow yield is currently very low. This is also related to the higher price to earnings ratio. EPS growth is also estimated here as quite impressive growth, around 30%. The valuations at Seeking Alpha are also on the high side, of course, and significantly higher than the sector median. It is noteworthy that the fact that they provide has a sell indication, and that doesn't mean everything. Only the combination of factors is not very favorable, mainly due to the high valuation combined with poor momentum and the downward revisions, as analysts think. Wingstop will perform less well in the short term, which could put more pressure on the price in the short term. As I mentioned, the Market value is small, about 6.5 billion. They themselves have a decent cash position, and long-term debts are not significant at the moment. If we look at the growth figures, well, they are quite impressive. So the 5-year revenue growth is around 20 to 25%. That is, of course, very high. The same applies to the EBIT and EBITDA figures, and also the EPS growth that has been realized. This model here assumes a slightly lower EPS growth over the long term of 3 to 5 years, namely 15%. So ideally, you would want this to be even higher for a good stock. And that, of course, also adds some more uncertainty. So all in all, and look, this might be the reason why you would want to invest. They simply have a very good conversion at every location that is open. That is, of course, super good. So that is often a no-brainer in terms of investments. And that also leads to them having, for example, a higher return on total capital of 25% annually on average, which is very high. And if they can maintain this for, let's say, 10 years, then I believe the current price is not particularly high. The income margin is also rising compared to the 5-year average. So apparently they are doing good business. So all in all, a nice example of a growth stock. But as you know, with all good stocks, in the short term, large dips can occur, minus 50%. As I mentioned, 2022 was a correction of minus 55%. So keep in mind a lot of volatility. Can the stock drop further? Yeah, that's always possible. Maybe even to the level of 2021. Then you have about a 21% decline. And if it drops even further, yes, then you see that even from this level, a stock can still drop by 50%. I don't know if it will go that far. If you're on my mind, if you can buy Wingstop under, for example, the price earnings of 30, then that's obviously better than the current price earnings. But I think you really need to think long term here, and yes, ask yourself if Wingstop can still open so many more stores that it's just a mathematical calculation, and also keep in mind that they might be successful internationally as well, because those are the more difficult questions where you, of course, need to do much more research yourself. If you really want long-term investing in a stock like Wingstop, in the short term, it doesn't seem very favorable to me. But that aside, finally, another interesting growth stock for the very long term is Descartes System, group with the ticker DSG, or the USA ticker DSCX. Small differences between DCG and DCGX is a buy signal in the short term, as you can see here, but that's purely a piece of chart. We shouldn't focus too much on that. Perhaps more interesting to elaborate on is the volatility of this stock. In 2018, there was a sort of correction on growth stocks, and then the stock only dropped by 20%. I say only 20%. Compare it, for example, with NVIDIA, it dropped much more during the same period. Also, during the COVID-19 crisis, the stock only dropped by about 30%. And also in the correction of 2021 of growth stocks, where in this case, we take the peak, the stock also only dropped by about 30%. Other comparable stocks or companies' growth stocks have dropped by more than 50%, sometimes even by more than 70%. So the volatility, the short-term price fluctuations of this company are actually quite manageable. So that is actually quite interesting to further investigate why, after the last market drop, the stock market fell by about 15%. But recently, the price has risen again, and the drop is now only about 15%. Well, that's all very nice. But what you might want to look at is perhaps this chart here. You see a huge long-term development. Now, Descartes System Group has actually been employing an interesting strategy in recent years. Namely, they simply acquire a lot of different companies within their sector. I am not yet at the point to say, oh, this is really a great stock to buy now. But let's take a look at a few things. I find it very interesting what they do in the note is offer all kinds of logistics solutions. And this might be under pressure in the short term due to deglobalization. And as a result, we might also see if inflation rises in America and costs increase rapidly, that this will have an impact on the business results of various companies that fall into this group. They offer all sorts of things like Everything for logistics. Also, custom regulations, which might work out well for them. Also, a kind of forward enterprise system. And a few more other things they offer, and they simply acquire a lot of these types of companies. This has both advantages and disadvantages, by the way. Now, the CEO, who is a truly experienced man, more than 30 years of experience in supply chain and logistics, and has been active as the CEO within the company since 2013. You have all sorts of other people who all seem experienced and knowledgeable on paper. But anyway, the most important thing is perhaps, of course, the demonstrable result. And what we see is a demonstrable rapid growth curve. So that is very interesting. But there might be more to mention now. And regarding the fiscal highlights of 2025, it's actually just a list of various acquisitions. Some are larger, others are smaller in terms of acquisitions, and the market value of the entire group is currently around $8 to $9 billion. So not extremely large. What I wanted to see later is, originally this company comes from Canada, but the revenue distribution is actually about 65% from the United States, 25% from Europe, only 6% from Canada, and a bit in Asia. And so if things go less well in the United States, is doing less well, both internally and externally. With logistic transport movements, then that also has an effect on the Scati system group. But most shareholders are not worried, because the short term, so the decline loss is not even that big, and actually a bit in line with the index, for example, S&P 500, but a lot less sharp than, for example, volatile growth stocks. I also find it interesting to see when you look at the net income, it continues to increase steadily, but they spend relatively a lot on cash acquisitions, as you can see. And also in the last year, 2025, they spent quite a lot on acquisitions. Despite this, they have relatively little debt, so that is quite remarkable. The Morningstar rating is 3.3 stars, and they indicate an economic moat as wide, and their fair value estimate is $96. That is somewhat around the current price level. There are, of course, also people who are not in favor of the acquisition model, and they point out that it can naturally bring more costs, distract management and such matters. And there are also a number of bulls who, of course, do see some things, but here, for example, it mentions increasing globalization. Well, in my opinion, that standpoint is not certain at the moment, but that could be short-term due to a president who might be gone after 3 years. Analysts in the short term give a price target of 135. That means plus 30% from the current price. Yes, if we look at the piece of historical development of this company, the price to earnings, so to speak, has been particularly high in recent years. Only price to earnings might not really be the right methodology to look at. After all, they are trying to reinvest as much of their cash as possible. And so you might want to focus more on, for example, the EBITDA. If we look at a piece of simple forecasting where this model is not suitable, because it's mainly suitable for really more stable companies, I would say. And the current price to earnings is, of course, very high. It needs to remain high if you want to achieve a certain return to achieve. So that is, of course, a crucial question. You can also look at the operating cash flow, for example. The price to cash flow is currently around 40, and that is quite high. And the same applies here. Over a number of years, the price per cash flow or the price earnings must all consistently remain very high. If you want to achieve a certain return, realize. And in principle, that could be possible for this company, given the business model. Yeah, you do need a bit more knowledge of certain matters and trust to invest in it as well. I'm not yet at the point where I can say whether it's a great investment at this price level. Perhaps with a further price drop, it might naturally become a bit cheaper for the very long term. But it's crucial to understand how they make those acquisitions, how that contributes to the overall competitive position. And that is quite challenging. I'm not an expert in logistics myself. So more insight from me is in definitely needed, but perhaps you have more insight into the state of the logistics sector. Let me know then. There might be a good entry point in the very short term around the price level of 125. So if you drop much further, look at a piece of evaluation. The factor analysis is a hold, and the valuation seems very high. And as for growth, yes, the figures speak for themselves. Look at that. It all looks good. However, what does stand out to me in a more negative sense is that the return on equity is not particularly high, not even the 5-year average. Compare this with other serious acquirers, such as Topicus, for example. Yes, they have a return on equity above 25%, and you see that with others. We also saw it with Winstop in this video analysis. You naturally want a very high return on equity to achieve, so I wonder why that return on equity isn't so high. Net income margin or payment margins, they are all very high, so they are apparently doing good business. But I need more research into why the profitability figures are relatively lower than we normally see with successful serial acquirers. So the question is, of course, yes. Do you blindly trust the management and rely on them doing good business and buy for the very long term? Hope that this trend continues? Well, it seems wise to conduct more research to understand the company well, and especially to assess what the long-term trajectory is. But the initial signals look good in any case, and at least interesting enough to keep following na video, at least on your watch list. That was it. 3 interesting growth stocks for the very long term. All 3 can potentially to grow significantly, also considering the business model, but of course keep in mind the uncertainties and also the high price tags. That always brings a bit more risk. So the question is, of course, will the high quality be maintained with long-term growth? Yes or no? That is the crucial question. Do you have more insight about these stocks? Well, I appreciate it if you share with us. Thank you for that. You also help other people, and I would say see you next time.